As the gray rhino of inflation charges towards us, have you ever wondered, why do some stocks fall like kites with broken strings, while others stand firm like ballast stones? If you still attribute the changing wind of the stock market to whether the economy is doing well, then you may have been looking at the wrong battleground from the start. Today, we will use one video to thoroughly dissect the ultimate dilemma between value stocks and growth stocks under high inflation. At the end of the video, you will also see the latest 13 value stocks. Those are favored by top institutions at the same time. Before we start, we must distinguish clearly. Which are growth stocks and which are value stocks? Growth stocks bet on the future. They are companies with rapidly expanding revenues and ambitious plans. They may pay little or no dividends now and may even be losing money, but the market believes they will generate big profits 5 or 10 years down the road. Typical examples include tech giants and biotech upstarts from a few years ago. Their valuations are built on distant future cash flows. Value stocks, on the other hand, focus on the present. They are established, cash flow stable, old money industries, such as banks, energy, and traditional manufacturing. Their share prices are cheap relative to book value, and they are often willing to return real cash to shareholders through dividends. The hard metrics used by major institutions are price to book ratio and forward PE ratio, below those of the S&P 500, and a dividend yield above that of the S&P 500. Meeting these three criteria qualifies as a true value stock. Many seasoned investors and even some professional traders have long believed in a dogma. As long as the economy is strong, value stocks will outperform growth stocks. But under the current market trend, this is wrong. Let's make an extreme assumption. If inflation stays constant and the economy suddenly starts to recover strongly, would growth stocks not grow as well? No, growth stocks also benefit from economic prosperity, and because of their greater earnings elasticity, they may even rally more than value stocks. Therefore, the economy has never been the key variable that separates the winners from the losers. So who is the real judge? Inflation. Why? This involves a fundamental financial logic, the discount rate. Imagine this, a growth stock's valuation depends heavily on $100 7 years from now. With inflation at 2%, that $100 7 years from now is worth about $87 today. But if inflation jumps to 4%, that same $100 7 years later is worth only $76 today. The higher the inflation, the more the present value of that future money shrinks. The valuation edifice of growth stocks is built on a castle in the air, and inflation is the knife that cuts the ropes. In contrast, value stocks derive most of their earnings from this year, next quarter, or even this month's cash flows. These monies require little discounting because they are about to be pocketed immediately. Hence, high inflation has only a negligible damaging effect on value stocks. Let's look at reality. Just in the past month, the 12-month trailing change in the US CPI jumped from 3.8% to 4.2%. At the same time, value stocks outperformed growth stocks by a whopping 4.4 percentage points over the past month. What does that mean? That translates to an annualized excess return of over 60%. Some might say this is a coincidence. So let's stretch back to 1947, nearly 80 years of data. Divide all months into 4 tiers based on how much higher current inflation is compared to a year ago. The data shows a perfect monotonic pattern. The higher the inflation relative to a year ago, the greater the excess return of value stocks. Conversely, when inflation falls, growth stocks take the lead. This is an iron rule that has been repeatedly verified over 80 years. Now let's look at those top institutions that actually manage money and whose performance is publicly audited. What are they doing? Among these top institutional products with verified track records, only 15 stocks are currently co-selected. Strikingly, 13 of them, a clear majority, belong squarely to the value stock camp we defined earlier. Why? Because they know full well that the stickiness of high inflation far exceeds the Fed's expectations. Allocating to these 13 value stocks is not really a bet on sectoral themes. It is a bet on the macro trend that inflation will remain elevated for a long time. They are voting with their capital, and this has directly translated into crowded long positions in value stocks. These 13 stocks are Abbott Labs, Archer Daniels Midland, Air Products and Chemicals, Bank of America, Comcast, CVS Health, Walt Disney, Fifth Third Bancorp, General Mills, Morgan Stanley, Pfizer, Charles Schwab, Snap-on. So remember today's core takeaway. Under the current expectations of a shifting bull-bear market, the style contest in the stock market, On the surface, it's about sectors, but in essence, it is about inflation. Growth stocks are like eagles soaring high in the sky. They fly high, but they are most vulnerable to the magnet of high inflation pulling down their future value. Value stocks are like giant trees rooted deep in the earth. They grow more slowly, but they stand firm in storms. Every tick of the CPI data adds or removes weight from the market scale. Looking at those 13 value stocks that are being collectively bet on, we should take heed. Inflation persists and value reigns supreme. In this era where the discount rate is king, stop paying excessive premiums for distant dreams. Keep your feet on the ground and embrace the cash flows of the present. That is the ultimate choice to navigate through cycles. This is US High-Tech Stocks, bringing you the underlying logic of the capital markets. We look forward to your comments. Cut through the noise and see the real picture. If you're vibing with this content, smash that like button and subscribe. See you in the next one.